Look, we've all heard the market doomers before. If you're not familiar with what a market doomer is, it's somebody that's constantly running around saying the sky is falling, that we're going to see some major market sell-off, and generally that's going to coincide with a major economic catastrophe like 2008 financial crisis. Now, today's episode is not specifically about market doomers, but it's more so about how a recession and the potential market sell-off that coincides with it could actually be an opportunity to make money. Crazy concept, I know, but you don't want to miss it. Welcome back, guys. Be sure to hit that like and subscribe button if you like today's content so that you keep getting content just like this. And of course, if you need help with your own financial plan, whether that's investing, coming up with a tax strategy, whatever it may be, reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. So let's make something very clear off the jump. I'm not predicting that a major economic collapse of some kind or a recession is going to automatically result in the market just going on some sort of rip. I'm also not implying that a recession won't result in market volatility. However, what I am trying to get across today is that a recession and a potential sell-off from it could create opportunity, especially given today's economic and market environment. And I think one could argue that given the current circumstances that you are going to hear about, that markets could potentially benefit from it. So without further ado, here are my reasons why a recession could potentially be a good thing for the stock market. So reason number one, there's $6 trillion in money market funds on the sideline. So over the last few years, the Feds have been incredibly aggressive about increasing interest rates, and we now are in an environment where interest rates are at a multi-decade high. Now, if you've ever taken an Econ 101 class, one would suggest that when the risk-free rate of return is very, very high, that the price of risk assets like stocks would go down. And the reason for this is that if you can get, let's say, 5% just hanging out in a high yield savings account with zero risk, why would you invest in something like the stock market that has historically generated, let's say, an 8% rate of return, but has the potential to go down, let's say, 40% in a major sell-off? This logic is a huge reason why the cash that's currently on the sideline right now has swelled to nearly $6 trillion. Now, if we were to hit a major recession, especially with inflation starting to cool, one of the key tools that the Feds has on their tool belt to stimulate an economy that's in rough shape, that is in a recession, is their ability to play with interest rates. And historically, it's been one of their favorite tools to utilize. The Feds cut rates to provide stimulus. So again, flip side to this, imagine the interest that you earn on cash is now more like 2%, and there's $6 trillion sitting in money market funds that no longer is getting that attractive of a yield. Well, that almost inherently forces those dollars to go into more growth-oriented assets that could generate a higher rate of return. So not only does something like investing in stocks look more attractive if that were to happen, but stocks could conceivably be at a discount at that time because there's volatility associated with a sell-off induced by a recession. Bottom line is, the argument here is that there's a lot of dry powder on the sideline, an insane amount of dry powder, and that those dollars are just waiting to hop in and buy assets when valuations maybe come back down a little bit and when they're forced to due to rates coming down. My second argument to why stocks could potentially benefit from a recession and from a sell-off that comes from it is that markets historically perform very, very well when rates are cut. So again, this is under the assumption that if we were to fall on really tough economic times and there was a recession, that the Feds do what they historically have done, and that's cut rates. So since 1928, there has been 22 primary rate cutting cycles. And during these periods of time, in the 12 months after the Fed started cutting rates, the average real return for US stocks has been around 11%. Stocks also outperform cash by an average of almost 12% during that time. What's more interesting is that in 16 of the 22 cycles when rates got cut, the US economy was either already in a recession or ended up being in one 12 months later. So again, this just further builds on point number one, that when rates get cut and money is almost forced to go into riskier assets, that historically that happens, and that creates this really strong outperformance data. My third and final point is that recession-induced bear markets oftentimes create opportunity. In a study done by Fidelity, looking at the top 50 days with the highest returns in the S&P 500 from January 1980 all the way to December of 2023, 50% of the top 50 days were during a bear market. Now, when you think about bear markets, that's not usually what you think of, right? You usually don't think of the stock market going on an absolute tear during those times, but that's exactly what the data suggests. In fact, the data suggests that really big money is made during these periods of time. And to build on this, when markets entered a bear market in 2020, stocks rallied approximately 70% from March 23rd, 2020, all the way to December 31st, 2020. We saw a similar run up in 2009 when stocks went up about 69% from March 9th all the way to December 31st, 2009. So the bottom line is this, is that historically, recessions and the sell-offs that come from them actually have shown to create a lot of opportunity, and that this is where big money can be made. Now, I really want to stress this, that if you're someone that's just hanging out in cash or has way too much cash in your portfolio, which is a lot of people right now, the last thing I want you to think is, well, I'm just going to hang out and just time the market, right? Because there's plenty of data that suggests that that's a stupid idea too. In fact, if you look at market returns right now in 2024 and 2023, they're significantly outperforming someone who's just sitting in cash. So even though we aren't in that big bear market, right? The market is still making a lot of money, and someone sitting in cash is making some money, right? They're making their, 4.5%, 5% in a high yield savings account, but they're not doing nearly as well as someone who is staying invested and sticking with it in the long run. And in addition to that, when that big sell-off happens, or when that major recession happens and the sky is falling and everyone's scared, data suggests that there's actually a ton of money that is made during these times. So again, this episode, if you haven't caught the gist yet, I'm talking directly to all the people who are sitting really, really heavy in cash in their portfolio, who's scared to take action, who's scared to create an asset allocation, right? There's no better time to create a long-term investment strategy that aligns with your overall financial plan. If you need help doing that, reach out to us at www.modernwealth.com. That's modern, spelled with no vowels, wealth.com. It's been a ton of fun, guys, and I'll see you next time.